Good evening and welcome to another episode of the weekly market wrap. Today is, of course, June the 8th, the first week of the month of June. And my name is Daniel Ang, and I'd like to welcome you to another week of wrapped up for the week's activity in the marketplace. Now, before we get into the content itself, let me remind you that this presentation is not an offer to buy or sell any kind of securities, be it FX, CFDs, or any kind of margin financial products. The trading of any kind of margin products do carry the element of risk, so do understand your own risk tolerance before you attempt to trade them. And of course, I'll be sharing with you my views of the various markets and do understand those expressly my views and has got nothing to do with the sponsor, which is IronFX. IronFX has been sponsoring my event for the past year, and I am grateful for their support, and I hope you guys find their services reasonable. And of course, the content of this presentation has not been vetted by any regulatory body, so take that into advisement, and let's get started. Now, this week has been a week in which a lot of Fed members has been talking. So we'll be going through what their main highlight of their speeches are. And we knew that this guy, Jamie Dimons, the CEO of JP Morgan, has been very vocal about the state of the US bond market. And he has repeatedly said that we are going to see a crack in the bond market. It is going to happen. So he has actually given us a lot of warning that something nasty is coming along the way. And we have seen that over the last 2 months, especially since the start of Liberation Day, in which President Trump launched his tariff policy. And market has seen a wholesale desertion of U.S. assets, in particularly U.S. Treasury markets, and that is going to be a main theme going into this year and next year. Okay, and we are beginning to see cracks in the international bond market. We see that the Japanese are struggling with their own bond market because, very much like the United States, they have not been very successful in finding buyers to buy their government bonds, and that is also creating what we call a ripple effect on the U.S. bond market. Now, you have to understand that Japan is the largest holder of, or rather, Japan is the largest foreign holders of U.S. treasuries, and if they cannot find buyers for their own Japanese government bond, which previously we noted that the biggest buyer of JGB has been the Bank of Japan. Now, the Bank of Japan has been taking a different approach, and they are no longer buying. So what suddenly you find that the biggest buyer of a market suddenly is not there. It left a vacuum, and the rest are not able to plug the hole. So what would the Japanese government do? The government would have to find buyers for these government bonds. So how do they raise the money if there's no foreign buyers interested in buying the JGBs? Uh, the obvious choice is to raise money from the sales of U.S. treasuries, which they did. Okay, very prominently, they have been selling a lot of U.S. treasuries, taking back the U.S. dollars to basically uh, uh, to buy the JGBs. And that has a knock-on effect because if the Japanese, being the largest foreign buyers of US bonds, are having to salvage their own bond market, it will be a problem for the US Treasury because they find that foreign buyers are not buying the bids. And we have been seeing very, very poor take-up rate in recent auction. Okay, and we all knew this is the month of June, and June, the US Treasury has a lot of short-term treasuries that are maturing and they want to roll over. Okay, and in order to roll over, they need to be able to find buyers for their treasuries, whether it's just treasury bills or treasury notes or whether it's treasury bonds. And that would be a problem. Everything else being equal, they would have to come up with a creative solution to solve that. Later on, we're going to be talking a little bit about what that creative solution is. And I think I did cover that throughout the last few weeks. It is this bill called the Genius Act, which is they are trying to clear what we call that, to raise what we call legislation to regulate the stable coin. And I think there's a lot of speculation and rumors, and it all makes sense that the US is trying to bypass the Federal Reserve because in the States, the Fed is the one that can actually print money. Okay, they can create the money to buy the bonds that the US Treasury is trying to sell. And it does not look like the Fed is interested to buy the bonds. So instead of relying on the Fed, which has not been very cooperative as far as President Trump is concerned, because Trump has been talking about it every single week that they need to cut rates. And the speeches this week from the various Fed members is telling us definitely they are not in the mood to cut rates because they are more concerned about inflation as a result of this very disruptive tariff policy that has been rolling out. There is no end to it. We are fast approaching the 90 days pause period. And to date, uh, there is no one nation that has gone to the United States and said, let's sign a new deal. There's a lot of talks, but nothing has been signed to date. The one that has been talking about signing, about having a deal is the UK and the US. And China is only pausing, or rather trying to negotiate through the tariff policies. And the other major markets that may actually has a deal with the United States apparently looks to be India, but nothing has been signed, and the deadline is fast approaching. And President Trump is saying that he has no time to negotiate individually with every single nation. What he will do that he will dictate what tariff to impose on the various nations. So it's going to be no negotiation. What President Trump feels is the right tariff rate will be the one, and that will be it. Okay, and what we can see that this Genius Act is one way to bypass the Federal Reserve, because if they can get more people to issue stablecoin, which is what this is all about. Now, we all know stablecoin is not exactly a digital currency. Okay, it's a digital version of that mimics the value of the US dollars, but it is not US dollars. Okay, it is a derivative that has this underlying peg to the dollar. Okay, so what the new stablecoin dictate is that it must be backed by something real, something considered to be safe, which is US dollars or US treasuries. So the fact that it is going to be pegged to US Treasury offers the Trump administration or the American administration to actually bypass the Federal Reserve, to actually get the issuer to issue more stablecoin, because every issuer of stablecoin would have to back that by either the dollars or the US Treasuries. And there is no mention of leverage. That means they can leverage forever. Okay, now we all know the stable coin is basically being used largely by people who are trying to bypass the SWIFT system. Okay, that means to say that a lot of these monies are involved in money laundering. Okay, so right now with this Genius Act, they are trying to allow the underground money to float up. Okay, as well as genuine investment money to actually surface, because each issuer, whether it is HSBC or whether it is Meta, whether it is any companies, okay, there is no restriction on who can issue stablecoin, provided every stablecoin is backed by either the US dollars or the US treasuries. Meaning to say that they can take this on the laundry cycle. Let's say somebody issue $100 million of stable coin, and they will buy $100 million worth of treasury, for example, and then they get to earn the yield because the treasury has the yield. Okay, and what they can do is that they can take the proceed from the yield and then reissue more stable coin, and of course before you can do that, you got to buy more treasuries. So this can go on and on and on and on. There is no cap. So this will create what I think the idea is behind is to create an artificial, or rather an alternative demand for treasuries. Since foreigners are not buying, the banks are not buying, so they have to create another avenue of demand. So there's a lot of people who say that the Genius Act is actually created to create that demand for US treasuries. And if that is actually true, that means to say that the US government will for once and for one and forever actually solve the problem for issuing more debt. Okay, that means there's no need to have a cap on the debt.
So this it will be the main issue that we will be continue to watch in the month of June, because June the Treasury has to issue something like $6.5 trillion worth of short-term Treasury to replace the one that are maturing. Okay, then of course we have some more coming in September, but that will be maybe one third of what we are expecting to see in June, followed by another more than 1 trillion worth of bonds for the corporate. Okay, so we can see that there's going to be a lot of demand for credit, and whether the market can provide the liquidity, that is one thing we're going to watch. And with that, I think we also have to continue to watch how the Japanese central bank deal with the JGB issue. Okay, if that market cracks, I think it's inevitable there will be a ripple effect for the US treasuries. Okay, so we want to continue, because this is a very dangerous month to go in for bond traders, because all the eyes will be on bond trading. Okay, so uh, in the early morning hours of Monday, I woke up very early and I saw a piece of news in which there was a headline saying that Ukraine has actually penetrated deep inside Russia, something like 4 kilometers, 4,000 kilometers away from the border of Ukraine, and managed to hit the Russian nuclear bomber base, of which Ukrainian claim that they destroyed 41 of these bombers. Now, these are strategic nuclear bombers, okay? And they are right in the open. You see, the US and Russia has a START agreement, meaning to say that each country says that they have so much of nuclear weapons, and how much of those bombers they have, and they must be verifiable, and they must be packed very neatly in the apron, so that overhead satellites can actually see and count them. So that was also one of the reasons why the damage to this drone attack by Ukraine has been so devastating. Okay, militarily it is a brilliant success, but geopolitically speaking, we can see that yesterday and today, the Russian has actually responded with massive drone and missile strikes. Yesterday alone, I think there were 400 drones being launched against Kyiv, as well as the various oblasts within Ukraine. And there are also something like 40 hypersonic missiles being fired. Okay, and this morning I heard the number has actually doubled, 800 drones and maybe 50 missiles. So definitely they are hitting all the major facilities, including the weapon storage areas, and areas in which they suspect are foreign mercenaries. There are obviously some NATO troops uh, uh, within Ukraine itself, masquerading as trainers. Okay, so we can see that this war is definitely getting uh, to, to be more severe. So there is going to be every aspect. Today, I read a piece of news saying that the area in the Baltic has been very tense. There has been standoff between Russian aircraft and aircraft from the Norwegians, from the Finland, and we can see that there has been some contest over that side. And all we need now is uh, for an incident to happen, and this thing can blow wide open. Okay, so just be very concerned about the geopolitical situation as we are going into the middle of June itself. Okay, so and this is the initial reaction. In the morning itself, when I saw this news, gold went up by $27 from Friday's closing, and it managed to go a little bit higher to about $3,340 before it come off towards Friday. Okay, so we'll talk about it later in the chart itself. Now, this is one of the more outspoken presidents of the Federal Reserve Bank of Atlanta. His name is Baltics, and he has been also saying, now, whatever they are saying, the key word I highlighted here, the one of the key phrase is called uncertainty. All the major Fed officials that have come out to speak this past week all mention this word uncertainty. That means to say that none of them are sure where interest rate is going to head, okay, or at least more correctly, where inflation is heading, because nobody knows for sure the impact of the tariff. So they need to monitor, and that monitoring could take months. Okay, so what this guy is saying that he will continue to monitor the data coming in, and before they make a decision. Okay, so this is one member of the Federal Reserve. He's the president of the Federal Reserve Bank of Atlanta. Okay, so this is another, but she's a governor. Okay, and but she's a voting member of the FOMC. Okay, again, you can see the word here, uncertainty being highlighted. I see the U.S. economy has still been in a solid position, but heightened uncertainties pose risk. So we can see that there are still also not sure what will happen next. And I think the messaging is very similar throughout all the members that have spoken this past week. Okay, her name is Lisa Cook, and she's the governor of the Federal Reserve Bank. Okay, and a voting member of the FOMC. So this one is Austin Goolsbee, and he also mentioned the word uncertainty. With the uncertainty, I can't express that with too much confidence, because who knows if we wake up tomorrow and the tariffs are going back to 50%. So again, the tariff policy of President Trump is the biggest unknown in the marketplace, whether it's for policy making or for investors. So nobody really knows. I don't think Trump himself knows the consequences of his tariff policy. Okay, so this is something again we want to watch. The main thing is that the policymakers are so unsure as to which direction inflation is going to show up. Okay, so this is Patrick Hacker. This is the president of Federal Reserve of Philadelphia, and here I didn't highlight anything here where he says the economy remains resilient. Then he said we have to wait and see. Okay, wait and see again is the common phrase that they use. They're not sure which way the inflation is going to hit. So again, they will have to be watching the data. Okay. Then we have another Adriana Kruger. She's also a governor, although she's not a voting member this time, but you can see upside risk for inflation. So they're going to veer a little bit more to inflation being elevated. Okay, so they are very concerned as to the impact of the Trump policy, and they're all in the wait and see mood. Okay, so this will be another governor, I'm not sorry, another president. He's a president of Kansas City of the Federal Reserve Bank. And here you can see that he said he believed the tariff are likely to push up prices. So again, he is gearing towards higher and elevated inflation. So this is the thinking behind most of the members of the Federal Reserve. Okay. Now, let me move myself out of the picture here. Here you can see on Thursday, quite unexpectedly, according to Trump, nobody knows whether he calls presidency or presidency called him, but Trump claims that presidency called him. Okay, and they spoke for more than 1 hour on Kuwait, and I think the main key for President Trump just uh, uh, 2 days before this phone call, Trump has been complaining about China violating the spirit of the agreement which they had in Geneva. Okay, and China, of course, categorically denied that there is any breach on their part, and no details were released except for the fact that President Xi has actually extended an invitation for President Trump to visit China. And I read some commentaries in some Chinese blog, and they say that that is likely to happen sometime in September. Okay, and of course, Trump himself has also reciprocated by inviting President Xi to visit the United States. Nothing is agreed upon. However, both of them, representative of both US and China, are meeting in London tomorrow in an extended talk beyond the initial talk that they have in Geneva. Okay, sorry. So we knew this week we have a bit of a drama in the White House. Within 48 hours of Elon Musk leaving the US administration, uh, he being a major financier of the Republican Party, which resulted in President Trump's winning the election last November. Now he is out of his role as the guy who's running Doge. Okay, Doge is still around. The thing is that the man himself decided that uh, his time is up because his original mandate was to run Doge for 130 days. Okay, and obviously his term is up, and President Trump uh, uh, accepted his departure. But apparently, that was the official line. The not so official line is that they didn't part on good terms, and everything blew up on Thursday itself when Elon Musk tweeted about how he felt betrayed, and there was a lot of vindicative messages and tweet exchange in the early hours of Thursday between President Trump and Elon Musk. And that has caused the Tesla share to actually slam down. Okay. And President Trump suggested that maybe he will cut off all the SpaceX project to save money. And what I also read earlier on, hours ago, was that President Trump has, with immediate effect, banned Tesla from producing their EVs in the United States. Now, remember, at the end of March, at the end of May, President Trump said all car manufacturers must move their production back to the United States. So now, 1 week later, now be, be, because of the flare-up between the two of them, President Trump has issued an immediate ban on the production of EV cars for Tesla, and that will be catastrophic when the market reopens tomorrow. Okay, so this is leading to a lot of bad blood being shedded. Apparently, his black eye that he has when he was in the White House with Trump just last week was supposedly a result of a fist fight with the Treasury of the Secretary of the Treasury, okay, which is Scott Bessent. Okay, apparently they got into a physical blow, and that resulted in a black eye for Elon Musk. But nobody is talking about it. Okay, so this is something is telling us that there are already cracks within the Trump administration, and Elon Musk is basically saying that the one big beautiful bill has got nothing to do with him. Okay, and he's very much against this bill, which has to be passed through Congress this month. Okay, and if that bill is passed, there's a lot of people saying that it will add something like $4 trillion to the national debt over 10 years. Nobody knows for sure how much damage it will do, but apparently this bill is something that is everything what Elon is not representing. Okay, Elon says the government is getting too big; they have to cut spending. But with this new bill, okay, it will cause the federal budget to actually explode. Okay, so he's definitely not in favor of this bill, and he's spoken out very openly about it. Now, this is what I was reading in the early part of Friday. Russia has actually responded with a massive attack on quite a wide swath of Ukraine, okay, with 40 ballistic missiles and 400 drones. Okay, apparently they have taken out major planning centers that has so-called foreign mercenaries. So this will be something that we want to continue to watch. Uh, Putin, President Putin was at one stage feared to be going for the nuclear option, but he is sensible enough to not push that button. Instead, he chose to respond with massive bombardment. Okay, and there have been to and fro. Okay, this morning I also read reports that the Ukraine has actually launched another attack on the Crimea bridge. Okay, which they have previously bombed, and they have also managed to derail uh, 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 trains, okay, although there's no fatality. So this is something that has been upping the game, and I think it is worth to continue to watch the development, okay? Now, the first economic data to come out this past week, okay, the one that has been getting a lot of coverage has been the Purchasing Managers Index. Now, we all knew there are two sets of PMI. One is by the S&P Global. This one is more watched. It's called the ISM. Okay, and for the manufacturing, we can see that it is not doing well. It has uh, not been able to recover. Previous month was 48.7. Market was expecting a bump up in a number to 49.5. It came in even lower than April at 48.5. So this is not good. And then when you look at this, which is the dark blue chart here, you can see that it has been declining since the beginning of the year from positive 50.9, 50.3, drop below the 50 line and stay below 50 lines. So this is basically a reflection of the contraction in the manufacturing sector in the United States. Now, for services, which all knew that America's economy is very much dependent on services, and that has also gone negative. It was 51.6 in April. Market expected to go higher to 52. In fact, it came down below 50, which is a contraction zone at 49.9. Again, when we look into the light gray, the light gray area from December onwards, this number has been going down, okay? And now it has gone below 50. So by and large, when we look into the services and manufacturing sector, they are telling us that US economy is definitely shrinking, okay? And we saw that in the Q1 GDP numbers, okay? And we should be able to get a clearer picture when the final GDP estimate is released on June 27th. Okay, then going into July, we will get a sense of where the Q2 is. But based on what we can see in the PMI numbers, it does not look good. Okay. This is the private ADP employment data change, which is the employment change. And we can see that there was a massive decrease in the creation of jobs in the private sector. In fact, since the beginning of last year, this is the worst number we have seen. So in terms of the job market, private numbers are beginning to show that it has shrunk dramatically. Okay, so this is definitely not a good development. Okay, so again, we want to consider to watch this. Okay. Now, this is the non-farm payroll. The non-farm payroll is a decent set of number. However, it did not take into consideration a lot of, there's a lot of funny numbers that doesn't tally. For example, they have lost 600,000 jobs, okay, over the last 2 months, okay, and unemployment rate remains stable at 4.2, okay. We also saw that non-farm payroll was lower from the month of April. It was 177,000 and was revised down 30,000 to 147. In fact, this number is not the only month in which they revised the number lower. For April number, it was also revised lower. The April number was even worse. Okay, this one was down by 30,000. The April number was down by 65,000. So nobody looked at revision numbers, but it showed us that this number is not sustainable. Okay, so although it does looks good on paper, it doesn't look like it's any major damage from 147 to 139, for example. It does not look too bad. Okay, but I think the number just does not make sense because all the other numbers is telling us that the labor market is actually shrinking. Okay, so the average hourly earnings looks decent because for the first time we see a bump up in the year-over-year earnings. We meaning to say that the wages has gone up year-over-year to 3.9%. Okay, which is a good development, suggesting that if this number uh, is being expressed into more consumption going forward, then there will be it will show up in the retail sales. Okay, but we will continue to monitor this because it is just 1 month. Okay, and we have seen throughout the last 9 months, this number is not been a number that has been breached. Okay, 0.4% is the month-over-month number. The 3.9 you can see is about there. Okay, it has not really improved a lot. Okay, so we have to continue to monitor this. So this is the updates for the equity markets. You can see that the Dow Jones. I think this is not fully updated. I think we'll update to Thursday. So I don't want to show you this one. Okay. In fact, all this I don't want to show you because I did not update up to uh, uh only update to Thursday. So the one that's coming up for this next week, the focus will be on the CPI numbers. We expect CPI numbers to continue to show the same move. Okay, essentially there has been a marginal uptick in the month over month. The year over year number continue to show that there is declining, but this decline could be what we consider to be a disinflation. So when this number gets lower, it doesn't mean the inflation has gone down. It could be showing us that there's less spending. Okay. Now the core PPI numbers, again, no estimates, but you can see that the previous number that we saw in the March was 4% down to 3.1%, which is a good development. But again, when you look at it from the fact that producers are not placing more orders for materials. So that could also be interpreted as the fact that producers are basically holding back their what we call that, their forward purchase of materials. Okay, so that result in lower PPI numbers. So this one is very telling. The Michigan Sentiment Index has practically collapsed. From the end of December 2024, we can see that this number has been coming down and is now barely holding above 50. Okay, so no estimates here. We do not know what will be the actual number coming up, but it will be a disaster if it's coming below 50. All right. So this is what we have in terms of the things that has been moving the markets of late. And now we want to go into the chart itself. Now, if you have any question, do post them into the chat or Q&A. Okay. We'll start off with the Dow Jones. I think there's a question there. Let me go to that question quickly. Tanvi is asking if the bond market in US breaks down, this is just for the short-term treasury. Also the long-term bonds, what are the impact to the other asset classes? Now you got to understand, the Federal Reserve can only control the short end of the curve in the treasuries. They have practically no control over the long end, means the 20 years, the 30 years, the Federal Reserve has no sway over the long end. The market decide the market's rate in terms of the yield. Okay, so we can see this week there has been some unusual movements. We have seen that U.S. Treasury has been buying the long end of the curve. I think they bought $10 billion. Okay, and it is basically trying to influence the yield because there has been a lack of demand, and that's the reason why the yield has been climbing. So by providing a little bit of a demand, you hope that the yield can come down. But $10 billion is small change in a market that's worth trillions. So if the bond market actually crack, meaning to say that you can see very obviously in the yield that they have to pay. And because everybody knows the Treasury has to issue new bonds, so the yield is unlikely to come down because you know that it's a major buyer in the market. Why would seller accept lower prices? So in fact, it will be the exact opposite. Okay, in order to entice buyers, they will have to offer higher yield, and this is being shown in the long end of the bonds. The 30-year bonds is now in excess of 5%. The 20, the 10, the 10 and the 20s are above 4.5%. Okay, so if this yield starts to surge beyond what it is currently being quoted, that will signal further loss of faith in US assets. And this will mean if people are not in the bond market, where do you think the investors are parking their money? So that is one question we have to ask ourselves, because the bond market is supposed to be the safest asset you can ever own because it's backed by Uncle Sam. Okay, but now we have seen since Liberation Day in April, demands for US assets has gone down. Okay, that means people are not buying the private assets. Okay, they are more likely to be funneling their money into equity markets. And we are also seeing that in the charts. The charts looks deceptively bullish. Okay, the fundamentals are all wrong, but it does looks like the money is in risky assets again. And of course, there has been also a move concurrently in the bitcoins. So digital assets has also been seen to be a safe haven play now in a situation in which there is an obvious desertion of US assets. could that also flow into gold? Now, gold this week took a tumble, okay, especially on Friday, okay, largely on the feel-good uh, uh, expectation because presidency has made a phone call to President Trump, and that suggests there is a de-escalation. So when there is a de-escalation in that part of the world, there will be less demand for gold. But earlier on I did mention that situation in Ukraine and Russia is not looking too great. Okay, and the other hotspot remains hotspot. Okay, Israel has been itching to attack Iran, but President Trump is telling Israel to hold on because they are in direct negotiation with Iran. And I think they have spoken for 4 times already. And Iran has outright rejected US demand to send their enriched uranium to a third country. Okay. And they have flat down rejected that offer. So it looks like if there is no breakthrough in the talk between Iran and United States, then it will give the Israelis free hand. But if Israel should attack Iran nuclear facility, it is almost inevitable that the United States will be dragged into this fight as well. And if the US is directly involved in this, it will change the dynamics. And nearer home, we knew 3 weeks ago there was a skirmish at the border between Cambodia and Thailand. And just hours ago, I read reports that they are massing more troops along the common border. Not sure whether that will result in uh, another outbreak of fighting between the Thai and the Cambodian, but we can see that things are not looking bright. And if any one of these result in something more catastrophic, you can bet the last dollar that the gold is going to find buyers again. Okay, but this week we saw something else different happening in the metal market. We saw silver exploded to the upside. Okay, so silver has been down, has been up, has been underperforming relative to gold, but we can see that this week something has changed. Okay, Anonymous is asking, may I know if the trouble in Japanese bond market will have negative impact on the Japanese yen? Obviously, okay. Now the Japanese has been looking to hike interest rates because there are already signs that this inflation situation in Japan is rising. So in order to cap inflation, the Bank of Japan will be leaning towards wanting to hike interest rates. And if the high interest rate, it will have major consequences in the yen carry trade. Okay, people you used to borrow in Japanese yen now will be under pressure to unwind the yen carry trade because the yield in the JGB looks like it's going to go up as a result of the Bank of Japan wanting to hike interest rates. Okay, so I think that the Federal Reserve have been working very closely with the Bank of Japan by providing them the dollars. Now, imagine if the Japanese has to support their own JGB markets. They have to find the money to buy the bonds, okay? And where does the money going to come from? Obviously, it's going to come from overseas where they park a lot of money in US treasuries. And in order to prevent the Japanese from selling the US treasuries to take the money back home to support their own JGB, the Americans definitely will be in the best interest to make sure that they don't sell US treasuries. And in order for the Japanese not to sell, they must have access to dollars. Okay, so I think there is that currency swap that the Bank of Japan is looking at. Uh, right now, we can see that there are two camps to whether the Bank of Japan will hike interest rate. If it hikes interest rate, the dollar yen is going to go down. Okay, that means the yen will be stronger. Now, if the US provide the Japanese with ample supply of dollars, then there is no need for them to sell the US Treasury bonds and no need to intervene in the currency markets. Because the last year we saw at 162 to the dollar, the Japanese intervened very aggressively. Okay, so we will be looking at the Japanese yen chart later on and then decide whether which way you will. Technically speaking, the dollar versus the yen looks about the only exchange rate that is going up in favor of the dollar. Now we know the dollar has been coming down since January. Okay, but against the Japanese yen, it is doing relatively well. Okay, and that has a lot to do with the pressure being imposed on the Japanese policymaker not to get the yen stronger. But it will be a decision that will have to be decided by the Japanese policymaker, which one involve less pain. Okay, but eventually something will break. The other one that we want to be looking at actually will be the Swiss franc. Okay, the Swiss National Bank also went into QE during the period of COVID. Okay, but what the Swiss National Bank did not do, which the rest of the world do, they all print money. Okay, but the Swiss National Bank print the money and they went about to buy foreign assets. Okay. And this will have consequences because more than $1 trillion worth of Swiss franc was printed and they are floating outside of Switzerland, in which they have no control over those exchange rates. Okay. And that also has a direct impact. This week, we have a earth-moving news, but I have been reading the papers. Not many mainstream media has been talking about this particular piece of news, which is the Swiss National Bank has required the UBS, which is the largest Swiss bank, okay, after the exiled Credit Suisse, to increase their reserve by as much as 27 billion Swiss francs. There is not much, there is not a lot of money that's floating around in which the UBS can actually tap to raise this money, okay? Because if they fail to raise the required reserve, okay, that means they would have to sell assets. Together with the Swiss National Bank having parked their money overseas, it means there will be a wholesale disposal of foreign assets, and that includes equity markets. So you want to watch this thing because the fact that very little has been reported in the mainstream deserve attention. Okay, most of the time we only get to know the news after it happened, but this is something that is ongoing because inside the books of UBS and Deutsche Bank, the amount of toxic asset that they have in their books is unbelievable. Okay, this is a carry on from the global financial crisis back in 2008, 2009. So we can see that they have been sweeping all this under the carpet, hoping to hold all these assets to maturity, and they are not even marked to market because some of them cannot even be valued, okay, because there is no, it's not a very liquid market. So this is actually quite scary when you think about it. I think that will be keeping the bankers wide awake at night, thinking about the UBS exposure to a lot of all these toxic assets that they have in their books, okay? And to make it worse, because they are a major counterparty to a lot of trading banks. So if UBS get into trouble, the number of the assets in the book of the UBS is even bigger than the assets of the Swiss government. Can you imagine the bank is much bigger than the total assets of the Swiss government? So if the UBS bank actually fail or have trouble, okay, it will cause a contagion in the global banking system. Okay, so you want to know more about it, go and Google. Okay, I will encourage you to go and Google, okay, because it is very consequential. And the fact that very little is talked about it, make it even more hairy. Will this impact corporate bonds? This is by Raja Kumar. Yes, higher yield means, okay, whether it is government borrowing or corporate borrowing. Now, government don't borrow top rates, but anything above 5% is considered to be very, very high, even for governments looking to borrow money. So you can imagine if you are a private enterprise, you are trying to go into the debt market to borrow money, you will have to borrow in way excess of what the governments are paying. If the US Treasury is paying 5%, you definitely will have to pay beyond 5% to even get a bit. Okay, so that will be consequential. Not only is the US government in need of raising money, the private sector is also in need of in need to raise money. And this is not just US companies. During the COVID era when interest rate was near zero, everybody was borrowing from the US Okay, because interest rate was near zero, and is and all these bonds are due for maturity. A lot of people and corporation will have to renew. Okay, so this is something that is happening in the background. It's not happening immediately, but you want to be aware of it. Now, the US bond market has competition from other country bond market. This is by Davy Hong. If there is no buyer from overseas for US bonds, can Treasury continue to buy their own long-dated bonds without anyone knowing? Now, the Treasury this week, I did mention that they did something very unusual. They are in the market. They actually bought $10 billion of the long-dated bonds. Okay, one way is to inject liquidity into the market. The other one is what we call uh, buybacks. Now, if you understand the concept of buybacks, the companies periodically do their own buybacks. Okay, once you buybacks, you reduce the float. Okay, and that is one way to maintain high prices for public companies. But for the U.S. Treasury, okay, to do that, they are basically injecting QE, so-called QE has the effect of QE. Okay, but QE is the domain of the Federal Reserve, and the Federal Reserve is also right now. Hours ago, I read an article that suggests that they are also in the market to support the short end of the market. So while there is no buyer, it looks like they are trying to hold the line. Okay, the Treasuries is holding the long end of the bond market. The Federal Reserve is holding the short end of the bond market. And not sure whether these two are coordinating their move. Nobody knows for sure. And of course, once the Genius Act is passed, okay, we can possibly see yield started to reverse down very sharply. Okay, because earlier on I did mention that the Genius Act requires all stablecoin issuer to hold US treasuries, and that will create demand. And this is very vicious because on the one hand, uh, it does appear that the Trump administration is trying to bypass the Federal Reserve because the creation of money lies in the domain of the Federal Reserve. Stablecoin is, strictly speaking, not US dollars. Okay, they act and move like US dollars, but they are not US dollars. And the Federal Reserve has no control over stablecoin. Okay, so there lies the danger. If every Tom, Dick, and Harry can issue stablecoin, okay, and they can do it again and again and again and again to earn the high yield in the US treasuries, there will come a point in time where the majority of stablecoin issuers are long stablecoin. What if there's an incident that caused them the need to sell? It will have a catastrophic effect because right now one bunch of people are buying, and if there's reason to sell, the same bunch of people who have been buying needs to sell. That it will create a situation very similar to what I always call the exit in the cinema. When you go and watch a movie in the cinema, the only light you see and is clearly featured is called the exit. Imagine somebody shouted fire in the middle of the screening of a movie. The immediate reaction of the moviegoers is to run towards the exit, and there will be a stampede. Okay, so on the one hand, it could create the artificial demand for treasuries, but in the same vein, if something bad happened and they all have to exit, we will have the movie theater exit, the single exit scenario in which you can imagine. Okay, so this is something that we want to continue to watch again. Now, the Swiss tanks against the dollar. If the UBS has problem in disposing toxic asset, now UBS is not in a position to dispose any of the toxic asset that they have because this market is very, very illiquid. In order for you to dispose, somebody must want to take over. Okay, there is nobody who wants to take over. So what they do is that they'll keep them in their books, okay, and hopefully nobody collapse in the interim. Okay, so right now, does the Swiss government favor a stronger Swiss? Not necessary. Okay, remember when the episode about the Swiss franc peg against the euro dollar, the reason why the peg failed was because there was demand for Swiss francs during the period where we have this European debt crisis. Everybody is looking for a safe haven, and the only place they can find safety is the Swiss franc. So there was a lopsided demand for Swiss franc, and it got to the point whereby the Swiss National Bank have to do daily operation to sell their own currencies to cap it so that the euro dollar and the Swiss franc peg can maintain. And one day, without notice, they just unpack the currency because the Swiss franc is just getting too expensive. Imagine having to sell your own currency in a market whereby it is trying to break higher. It is very, very expensive. So at the end of the day, they decided it's not worth the effort and they just released the pack. This could also happen, okay, if right now the dollar has been coming down. Where do you think investors are parking their money? Do you think they'll be parking their money in the in the euro dollars, in the Japanese yen, in the sterling pound? No, he'll be parking them in the Swiss francs. Okay, that's why you can see the dollar Swiss has been coming down very aggressively. Okay, so that will present another foreign exchange challenge for the Swiss National Bank. You know? Now, Anonymous is asking, with so many uncertainty now, but equity market still bullish, do I have any advice for us on how to manage our investment in the next 3 months? I would not categorize it as advice, but I don't do equity, but if I do equity, I think short term, okay, regardless of the poor fundamental, technically speaking, it does looks like equity market may actually be challenging all-time highs again. It is not logical, okay, but when you have a cratering of the bond market, which is supposed to be a safe investment, you would not want to put your money in bonds, right? So where do you put your money now? Okay, gold has no yield. So for fund managers, they do not want to buy gold because it has no yield. Okay, the only way they can make money is capital appreciation. Okay, that means the price of gold will have to go ever higher. Okay, where else can they park the money? Bitcoin, I think some of them are spilling over to Bitcoin. Okay, but again, depends on the mandate. Some of them may not be able to invest in risky assets such as Bitcoin. So that leaves equity markets the only choice, not the best choice, but money has to go somewhere. Okay, so for now, despite the poor fundamentals, okay, it does looks like the momentum is gathering in equity markets for now. Okay, all right, this is my 2 cents worth. Let's get into the chart. Now, Dow Jones, when we look into the monthly time frame, now this is only 1 week worth of trading for December. We can see that the market momentum suggests that it may be favoring the upside. Okay, among the major equity index, the Dow Jones seems to be the weakest link. So it does means that international money managers, the what this index is not too bullish if they can help it. Okay, compared to the more retail-oriented equity index like S&P 500 and the National 100, those are the one that has exhibit very clear sign that it's about to take off again. Okay, so while the sentiments does suggest that we may see higher price, but remember last week I did mention about this three-wave equality move. The market has gone into this bracket of prices. Okay, it is there's no sign that the buying has subsided. There is no sign of that. So we do not know whether this can sustain or not on the daily time frame. On the 4 hours time frame, we can see that the market does appear to be challenging the upper end. Okay, so technically speaking, there is every possibility we will see continued strength in equity markets despite the less than ideal fundamentals that we are facing. In the S&P 500, let's take a look at the weekly time frame. Let's see the weekly time frame. Weekly time frame also suggests that prices are likely to go higher. Okay, so we have a very strong move in a weekly time frame. We are not that far away from the all-time high, 6,150. Yeah, it's just a stone throw away. On the daily time frame, you can see the market is still trying to go higher. Okay, and in the even the 4 hours has just broken the counter trend and is resuming its upside. So all said and done, equity markets does looks like it is poised to trade even higher in the coming days, okay, until something bad happens. So this is again new high for the year. There's a new high here. This one is okay. So you can see the National 100 is the strongest among the major equity index. Okay, it does looks like it's going to take off. Daily time frame, same thing. On Friday, we have a strong closing for the week. 1 hour, 4 hours has also broken, has also invalidated the counter trend. So right now we are in full-blown bullish bias, okay, across most time frame. So for US equity market, it does looks like it has a higher chance of going higher compared to a higher likelihood of coming down. Now in European equity markets, usually we'll take a look at the FTSE. You can see FTSE is also geared to take out the all-time high. So this is even more bullish compared to US equity markets. It does look like it's going to take out. There has been okay, quite a strong momentum to the upside. And that also eliminate the counter trend. So European market also suggests we'll be looking at higher prices. Germany is currently the strongest market in Europe. It has an all-time high already, 24,471.5 this past week. Okay, new all-time high. Daily also broke out. 4 hours have a new counter trend, but we can see that despite the poor fundamentals, and for Germany, the talk is that because the new German government is committing 5% of GDP to defense, and that's going to create a lot of demand for weapon manufacturing, and that is the basis why we see the DAX being so strong. Now, what about Asia? When you look at Asia, it does look at Nikkei is actually underperforming. Now, it has been stuck, okay, ever since it hit 38,774. That was 4 weeks ago, okay. So now we have a bit of a rally attempt, okay, but the momentum has obviously been a little bit affected. So there is not a very strong momentum in the Nikkei 225, possibly due to the difficulties of whether to hike interest rates or not, okay. Not hiking interest rate is definitely good for the Nikkei 225, but I think the Bank of Japan, seeing that the inflation, the CPI numbers has been climbing steadily, will be under a lot of pressure to want to high interest rates. Okay, and that will make the yen stronger. Does the US Federal Reserve want the yen to be stronger? I think yes. In fact, they want all currencies, all trading nations' currency to be stronger relative to the dollar. Okay, since they're not going to get any help from the Federal Reserve by cutting interest rates, they are basically forcing the dollar value to go down by creating a lot of stress with all this tariff policy, the on and off tariff policy, creating a lot of uncertainty. So this actually caused a lot of other players, sovereign or otherwise, to reconsider their exposure to US assets. And this will mean they will be looking to sell dollars because they need to pare down their exposure to US dollar assets. Okay, and that means once they sell the assets, they will have to take back their currency. It means they will have to sell the US dollars and bring their currency back. Okay, so when they do want to bring back the money back home, okay, what they can do is to reinvest them somewhere else. And I suspect a lot of that has gone into gold. Okay, so this is the daily time frame for the Nikkei 225. It does appear that if we're going to get a three-way pullback, somewhere between 35,600 to 36,100 could be a good area to look out for buying opportunity, because this market is still very, very bullish. Okay. All right. Hong Kong. Hong Kong actually had a good week. Now, this is the Hong Kong market. It has completed the bare minimum three-wave rally and experienced quite a sharp drop, or somewhere within here, 18,600 to 20,000, it found support at 19,000. So since then, the market did not look back And now that we have seen that phone call between President Xi and President Trump, market expectation is that things will look better, okay, not worse. And of course, a lot will depend on the outcome of the meeting between US and Chinese official when they meet in London tomorrow. If there is no bad news, not necessarily good news. If there's no bad news, it may actually be a catalyst for higher prices. Okay, this is the daily time frame. It still looks like it may extend higher. Temporary may not remove this. Okay, it does looks like we have a three-way pullback into equality bounce. So this is actually a very strong move. Very strong move. And it has turned positive. This is all good. So Hong Kong market has also turned positive even for the 4 hours time frame. Any question for me before we go any further? No question here. Looks like there's a couple of new questions. No new question. Next place we'll go to commodity, we'll go to gold. Also, we go to currency first. We go to currencies. Let's take a look at the dollar index. Now, this is the dollar index. The dollar index is still under a bit of pressure, although there's a bit of demand this week. Okay, so far this week, there's a bit of a demand. But overall, the trajectory suggests that we probably will see continual losses. Okay, yeah, earlier on, I did mention if this is an ABC move, there is a possibility of market targeting anywhere between 90.8 to 94.5. Okay, if this is equality move, because if you look at this from this perspective, this is a classical three-way equality, potentially three-way equality. So if this is equality, there's potential for the dollar to continue to go down, and meaning to say the dollar index to target anything between 91 to 95. Okay, so when you look into the left, 94.6 seems to be a swing low here. So if market continue to break below 97.67, all eyes will be at this level. Okay, I suspect do not sell anymore. Okay, for those who are scalping, if you're looking to scalp the dollar index, there's not much meat left already. Okay, the bulk of the move has already happened. Okay, so if you can afford to step away from this market and just observe and look for some kind of support to emerge, if and when market went out anywhere between 91 to 95 in the dollar index, that would be presenting a buying opportunity. Now, don't forget, the dollar index is long-term bullish. Okay, so I am still favoring the dollar to recover in time. Okay, especially if some kind of progress can be made between the US and China, and that will boost the dollar. Okay, but for now, technically speaking, it does look like we probably will see lower prices before we see higher prices. But I'm looking out for the possibility that the dollar may eventually recover. Okay, now let's take a look at the euro versus the dollar. The euro dollar is actually a mirror image of the dollar index. Okay, so if you can see an ABC move in the dollar index, we also see a corresponding ABC move to the upside in the euro versus the dollar. And if this equality move, there's a possibility of challenging 1.19. Currently, it's 1.14. Okay, 1.119 is a possibility here. Again, if you're not already bought, maybe it's a little bit too late, unless you are like doing it as a day trade. Okay, but it gets a little bit hairy once it passes beyond 1.16 because the risk to the upside has increased, whereas the reward is actually narrowing. Okay, so this will be how I look at the euro dollar. Now for sterling, it is almost quite similar, but the chart here is a little bit more not as clean cut as the euro dollar. By and large, you can see that there is a possibility of an extension move. Okay, perhaps if we do that, a target could be anywhere at 1.48. But I am thinking that the market will meet some kind of very fierce resistance at 1.42 half. Okay, 1.43, 1.42 half. I think these two levels are the key level to watch. Okay, don't think about the 1.48 just yet. Think about the 1.43. Okay, I think there's a possibility the market will see the re-emergence of selling interest around these two peak here. And if there's another peak that more or less correspond to these two peaks here, then it will create what we call a triple top. Okay, very powerful reversal signal to the downside. So if you still want to buy, just be aware 1.42 half onwards. It makes no sense to chase. Huh? Now I want to show you dollar Swiss. I've been talking a bit about dollar Swiss earlier on. You can see dollar Swiss has been very, very weak. Now, if this chart prices comes down, it shows that the dollar is weak relative to the Swiss franc. It means the Swiss franc is very strong. Now, this is only the weekly time frame. Let me show you the monthly time frame. You don't get a lot of data. As you can see, this is a long-term bear market. There was a period of consolidation. Usually, I don't trade Swiss because Swiss tends to be, this kind of movement. Okay, but we can see that over the last 3 months since April, we can see that the dollar Swiss rate has been plunging more than the usual move that it has on a month-to-month basis. So it does seem that something is moving the dollar Swiss franc, resulting in demands for Swiss francs. Okay, so Swiss franc does appear, yeah, temporarily we possibly will see a three-way bounce, but I think the downside risk is very much in favor because in a day time frame, this market is seriously in a bear market. Okay, right. Take a look at dollar Canadian. Does dollar Canadian accelerate to the downside? So we can see last year there was a run up in the dollar versus the Canadian, and it peaks in January. Okay, just days before Donald Trump inauguration, and since then it has been one-way street. And the way it moved, you can see that this move from the high here at the beginning of the year at 148 is accelerating. It means to say that this part here from 145 half does appear to be accelerating to the downside. Okay, immediate target is anywhere between 133 to 135. That will complete 1.618, and after that, there should be followed by a bounce no higher than this peak here, followed by another dip to complete the 5-wave down. Okay, so right now, dollar versus Canadian is still bullish. Okay, so in the meantime, if you believe the weak dollar scenario story, then maybe any bounce here may be worth a while to take a look. Now, dollar versus, I've shown you. Let's look at Aussie. Aussie has a bit of a bounce. Okay, we saw a massive recovery from just 80 cents. The highest trade at 84 cents, and the market closed at 83.5 cents thereabout. So it does look like they may be either sideways or a little bit to the upside, but upside also quite limited, honestly speaking. Okay, because the Australian economy has slipped back into recession. So when you have an economy that slipped back into recession, obviously the Reserve Bank of Australia has been cutting interest rates, and that should be seen to be an attempt to resuscitate the economy, and that may be seen to be positive. But when you have an economy that is relapsed into recession, you know that it is pretty weak. Okay, and Australia needs a catalyst to move higher. It needs China economy to recover sharply. Okay, because if the Chinese economy continue to languish, there is really no ballast within the Australian economy to be able to for it to climb out of the hole by itself. It needs China. Okay, so again, the Australian economy is so intertwined and so depending on the Chinese market. If you want to trade the Aussie, you want to look into China economic numbers. Okay. Every time there's a positive economic numbers coming out from China, the Aussie tends to benefit. Now, let's take a look at the Kiwi. Now, I also do not trade the Kiwi per se. But Kiwi is so much stronger compared to the Aussie right now. Okay. Yeah, it's getting stronger. So it did kind of break out this past week, okay, to above 60 cents. So Imagine it was 55 cents. Now it is 60 cents. It just looks like it has more scope to challenge at least the nearby peak here at 64 cents. So there is still a bit of a room, okay, for you to consider. But overall, this market is seriously bear market. All right. So we have covered the currencies. Let's talk about the commodities, unless you have something else for me. Okay, I don't see the number change here. So let's go into the gold market. Now, the gold market actually started the week actually quite respectively. Now, what caused the market to be able to hold up? This move here, okay, on a daily basis, punched through that resistance line, okay, for the first time. So what happened was the news that caused this was that successful attack on Russian military base in the Far East, 4,000 kilometers away from the Ukrainian border. So that piece of news targeting their strategic bomber is to me a major escalation. The Russian could have used this to activate and launch nuclear weapons because the strategic nuclear bombers are part of their defense. Between the US and Russia, they had an agreement. Okay. If you launch a nuclear attack on me, I can respond. And that could also extend to you attack my nuclear bombers, my delivery platform. Of course, President Trump said he doesn't know about the attack. But you think the Russian will trust him? They may not be directly involved, but I'm sure they have provided assistance. Okay. So this one news caused the gold market to rally. The higher traded was 3,403, and that was on Thursday. The moment news media started to report that President Xi called President Trump, the gold trade actually reversed. Okay, and it continued to come down. Friday, there was a bit of a pocket, okay, because the market failed to rally. There's a lot of what I call disappointment, and people who recently bought above this breakout decided to exit the market and wait and see. Okay, so we want to see whether there is going to be follow through selling. But by and large, this is a very seriously bull market. Now, the alternate counts here is this. Previously, we have three-wave pullback and a rally, a break of the resistance line. That is by itself very bullish. But the fact that prices are not coming back into this resistance line, okay, either it holds at its current level and start to recover in the next few days, or the market go lower in a larger degree three-way pullback, targeting $3,000. And then when you look into this $3,000 area, the lowest swing low here is 2,956. Is it possible? Well, everything is possible. Okay. So if the market ever come down like this, for those who have not already bought, this will be possibly the last time you can ever buy gold at affordable prices. Okay, because the overall trend in the gold market is so strong. Okay, so strong. June could be the period of consolidation. Remember all this time at the end of March, okay, after the market did a three-way pullback, I'm saying that, yeah, technically it may have finished its most basic correction, but there is a possibility that this thing can drag on into June. So now we are in the first week of June, and prices of gold, despite the news, okay, on the war front, has not resulted in a breakout move. So it means that we may see a bit of shaking off the weekend. For those who bought at most recent level, okay, above $3,300, these are the weekend, especially retail investors, right? So if the market continues to go down, then it could create the condition for more liquidation below 3,121. But once the weekends are out of the markets, okay, the big boys will come in to buy. I think that will be a possible scenario. Okay, so this is lower to buy. Like I said, if the market ever come down to this level, I am definitely a buyer. Okay, I have already bought, okay, on a breakout. Okay, I'm still holding on to this position. So this is the 4-hour time frame. So this is the reason why we are still not necessarily going to be able to see price of gold come down. It's just sitting on this line on 4 hours. Things will change if it breaks this level near term, 3,245. If the market breaks this level and close below this level, yeah, the immediate incentive to buy will not be there. Okay, because based on this, a three-wave larger degree pullback will result in a move towards the $3,000 level. Okay, 3,000 to 3,140. So maybe people who bought after the breakout here will be under a lot of stress to cut loss if the market take out this low here. But I think once the market goes out into this bracket, we may see tentative return of buying interest. Okay, because the overall higher time frame suggests that we're going to see gold market continue to rally. Now, the surprise this week has been in the silver market. Silver had a very strong move. Okay, it did a three-wave pullback, hit equality, and then a little bit more before it rallied. Okay, so this is a very interesting move. It suggests that we know silver has been underperforming its gold for quite some time, and this could be providing the catalyst for higher silver prices. So if you have to be in the precious metal market, right now it seems that the play is in the silver market, as well as in platinum, and as well as in uranium. But we don't trade platinum, we don't trade uranium. But it seems that prices in especially uranium has been climbing. Okay. You can see this is the daily time frame, market broke out. So it does appear that with this count here, this three-way pullback resulted in a fourth. The market is resuming the last leg of this move. Okay. Now, why do I say that? If this is a 1, 2, 3, 4, 5. Now we have seen the resumption of this bull run, and this could be the most aggressive move. Okay. So if we do a simple Fibonacci expansion with what we already know, 1.618 is actually quite doable because it suggests there is momentum and very serious momentum behind this one. The market is not going to give you a lower price. So this one, you've got to adopt a more aggressive mode if you want to be playing the silver market. Right? Near term, based on the daily time frame, just this last leg here, it should have a 1, 2, 3, 4, 5. Okay. Right now, we only see a three-wave move. Okay. It will be targeting $40. All right. Was originally looking at $37. But now it looks like if this is the resumption of the run here, this leg here from $31.64 has the potential to go all the way to $40 before it meet resistance, followed by ideally a three-way pullback and then one more last leg before everything comes back down to here. Okay, so based on what we see in terms of momentum, it does appear that silver seems to be the place to be. If you are going to be scalping, that will be great because the market is now breaking up. It's in a breakout move here. Okay, so this is what I think is happening. Oh, there are a couple more questions here. Let me see. Dennis is asking, what gold price do I think can reach highest before the market starts to go down? I think we possibly have hit an immediate pocket. There is the possibility. Remember the 4 hours time frame that I showed you earlier on? Now this is 4 hours, right? Now 4 hours currently is sitting at the resistance line. Okay. And if this line fails to hold, meaning to say prices goes and close below this red line here, then there's a possibility of a challenge of the nearby support at 3,246. And if this one also fails, logically, it will cause price to unravel all the way down to 3,140 to as low as $3,070. So this will be a good area to pick up in my mind. So I'll be looking for opportunity here. However, if the market find buyer tomorrow, for whatever reason, the market will reverse back up again and close above 3,005, it suggests the same thing is happening in the silver market, is happening in gold market. So this 3,005 here is very important because so far we have a 5-wave rally. 5-wave rally, followed by a 3-wave pullback to this level. It is quite possible, okay, that this level can actually hold. And if I don't believe the price can go as low as 3,140 or $60, then I want to watch this level. If I see a reaction to the upside after it tests. Whether it marginally breaks below, ideally it marginally break below this level, okay, and then followed by a turnaround, I will be buying, okay, because I think the next leg of what we see in the silver market is going to be seen again in the gold market, okay, meaning say it could actually end up to be a 1, 2, 3, 4, 5 pullback, another one more round up, another 1, 2, 3, 4. So the next phase in gold and silver is actually very, very bullish, okay. So look out for momentum in the in the precious metal market. Now, I never shown you the platinum market because I don't trade that. Okay, but I do monitor them from time to time, right? It is also in a breakout mode. The market has been consolidating for so long. This looks like a rounding bottom, right? So the next leg, imagine the potential. The low for this move here is $820. To extrapolate this move here, even if it's not a 5-wave pattern, just a 3-wave pattern, from 561 to $1,300 down to $820. The extension suggests that there is a potential to go all the way to $1,577. And we are still $400 away. But this market is very, very, is not as liquid. Okay, but it does looks to be very promising. A break above 1,819 looks like a very logical move. Okay, this couple of weeks, you can see the first rally followed by a pause, another rally. So something is driving the platinum market as well. Okay, so as far as the precious metal complex is concerned, it does looks very bullish, with the only exception being a possible extended decline in the gold market. But even that is considered to be bullish for me. Okay. I did see the oil market. You see the oil market. The oil market does looks like it's going to be a bit of a bounce coming in for oil. The so-called climb down in escalation between the US and China is translated to being seen as bullish for the energy markets. Okay, so this could be the one reason why we can see gold oil market actually rebounded. But technically speaking, it is still in a very severe bear market. Okay, it's a very severe bear market. You can see the bigger box is pink color. So what we can only deduce is that this rally in the oil market is part of a simple corrective bounce. It's going to hit, it's going to meet headwinds between $65 to $67 and a half. Okay, and of course we have to contend with two immediate picks, which is this one and another one over here. Okay, $72 and $79. So the scope, something dramatic must happen before we can see a sustained rally in oil market. So this bounce, if you have not already bought, don't buy at this level. Let's take a look at Bitcoin. Bitcoin has gone into a bit of a consolidation after breaking into all-time high just 3 weeks ago. This is the weekly time frame. You can see that Bitcoin has actually rallied into all-time high, $112,000. Okay, followed by a pause inside bar. Now we are not even close. We have a few more hours before Sunday is over. So we can see that by and large, on a close-to-close basis, there's not much of a change. There is possibility it will continue to drift lower, but I would think based on the weekly time frame, there's a bit of a demand here, okay? This area, okay? Between 92,800 to 97,850. So if price do move into this bracket, go down to the lower time frame to see if you can find support. Right now, we found immediate support in the 4 hours, okay? And this 3-wave move. Even this, you can see this is working out to be a 5-wave. 1, 2, because this move extended lower by more than 1.618%. So long as this level here is not overlapped, meaning to say that if price recover, it doesn't overlap $106,524 and start to come off, which it can, okay, and complete this 5-wave move below $1,300. $100,300, $100,300, okay. then that will be calling for a break below this level. So Bitcoin is in a bit of a wait and see, as well as there is no incentive to go in to buy now, unless the Genius Act get passed. Okay, if the Genius Act get passed, okay, this may provide the fuel for a rally in digital assets across the board. So let's take a look at Ethereum. Has Ethereum really moved this past week? It has also not moved a lot. You can see the market has been in this kind of pattern after initial boost. Okay, it has more or less hit an air pocket. It's gone sideways. Okay, on a close to close basis, nothing much has really changed over the last 3 weeks. So there is not enough momentum inside here. Yeah, no momentum. So if the price goes in the lower end of trading, okay, within this bracket of prices since May of last year, meaning to say 2,270 onwards, okay, the lower end, anywhere below, let's say this, let's say this area. I think this area will be a good area to gauge the demand. Okay, anywhere between 2270 to 2320. Okay, we should be able to see some kind of support. The market is also on the lower time frame, having a bounce. Okay, the overall trend remains bearish for the near term. Okay, daily time frame suggests is still in the bearish mode. 4 hours is still deeply in the bearish mode, but we can see the demand here has been very strong. So this is more like a flag pole followed by the flag move. Okay, so lower to buy, in my opinion. Here, I'll show you the last one, which is Ripple. Ripple seems to be doing well. Remember, there's a Ripple coin, and there is also the Ripple stable coin potential. Okay, so it does seem that compared to the other main coins like the Bitcoin and Ethereum, this Ripple seems to be finding support in expectation of a passage of the Genius Act. Okay, overall, it is bullish. It's a bit messy. Okay, but it does appear that $2, there's a bit of a support for Ripple. So this is the 4 hours time frame, looking very bullish. In fact, it was one of the best price to buy within this sequence. Okay. Okay. Anybody has any final question for me? Let me check. Sam is asking why gold and silver diverge. If you look at the gold-silver ratio, you'll know gold-silver ratio has actually elevated, quite elevated. Okay, I think it was last seen at 97. Okay, I think last week I did mention gold-silver ratio, right? It was at 97, so it's pretty high. So now that the silver has surged so much this past week, I will think the gold-silver ratio has come off a little bit. Okay. There is no fundamental change in the precious metal market. Okay, one thing I have to mention, there is a lot of delivery in COMEX silver. Okay, if you go and Google COMEX silver delivery, we have seen an explosion in delivery. And this is a bit unusual because in COMEX, most of the volume are speculative. Very few delivery results out of trading out of COMEX, and that also applies to gold. So since last year, delivery in the COMEX gold has been exceptionally high. And now this past week, we see very high delivery in silver contract. Okay. The May delivery is already closed. Okay. So the current active contract is for the July delivery. Okay. So if we see correspondingly high delivery in the silver market, that will mean people are taking delivery, meaning to say that this will equate to real demand. Because most of the trading in COMEX, whether it's silver or gold, are all for speculation, which nobody wants to see delivery. But if it's actually delivered, that represents the real demand. Okay. So do a little bit of homework on the COMEX gold silver delivery. Okay, if you want to find out why, whether it has enough momentum. Jockey is asking what is the average gold silver ratio. I, I'm not sure whether I have it. I don't have it. I don't monitor them because it's not that useful for trading. But it's good to know that beyond a certain number, it doesn't pay to buy gold. It pays to buy silver. Okay. Last I checked 2 weeks ago, it was at 97. So it means it's very close to 100. Meaning to say that as the gold silver ratio creeps towards the 100 level, it doesn't make sense to continue buying gold. So it could be a situation in which investors and speculators decided that I think it's time for silver to shine. Okay. Unless there's something else, which I do not know yet. Okay, there's nothing else. I will end the session. Thank you very much for attendance. Now, remember next Saturday I'll be doing a presentation for Kananga. So if you guys are interested, it will be held at the Curve, I believe. Okay, I'm not sure where is it called. The details are also on my website. Not website. It's also on my Facebook. So if you want, reach out to me. I will give you the link to register. It's free. So if you are keen and available on Saturday morning, it starts at 9 and at 12. I'll be talking for 2 hours solid. So if you've got any questions, in particular, the equity index and gold, because this will be the two products that I'll be talking about. So if you have questions for these two products and wants to meet me in person, uh, sure. All right, guys, thank you so very much. I shall see you either on Saturday or if not on Sunday evening. Bye bye. Take care.